In the final hours before the 1929 crash, Wall Street was not the confident temple of prosperity Americans believed it to be. Beneath its proud marble surfaces and polished brass railings, something unsettling was unfolding. Numbers were moving in ways that felt unnatural, erratic, as if guided by a hidden hand rather than by the simple forces of supply and demand. The ticker tape, that narrow lifeline of truth connecting the trading floor to the outside world, began to sputter. Its updates slowed. Its rhythm faltered. Within minutes, it was no longer a reliable witness. Prices printed that no longer existed. Investors stared at ghost numbers, unaware that their fortunes had already evaporated. In those hours, the truth became clear. The market wasn't collapsing in chaos. It was unwinding in perfect mechanical precision, precisely the way a system built on leverage, illusions, and unchecked speculation is destined to unwind. For years, Americans had been told that the stock market would rise forever, that progress was guaranteed, that wealth was limitless. Yet behind closed doors, far from the optimistic headlines and jubilant crowds, the very men who helped inflate the bubble were quietly preparing for the inevitable storm. Their conversations shaped who would survive and who would be sacrificed. Their decisions set the stage for the greatest financial catastrophe of the century. To understand the madness of those final hours, one must travel back to the beginning of the decade, a decade built on a seductive dream. The 1920s had gifted the country new technologies, new conveniences, and new ambitions. Radios brought news into living rooms. Automobiles redefined mobility. Electrification reshaped daily life. Advertising transformed wants into needs. Consumer credit gave ordinary families a taste of luxuries once reserved for the wealthy. America believed it was marching toward a future that nothing could disrupt. But the glittering prosperity of the era hid a silent threat. A new mechanism was emerging, one that the public embraced with excitement but barely understood. It was called margin buying. It's put down a fraction of the cost of a stock. Borrow the rest. Watch the profits multiply. It felt like financial alchemy. A way to turn every dollar into 10 and then 20. Wall Street brokers encouraged it. Banks funded it. Ordinary Americans rushed into the market with borrowed money, convinced the party would never end. Yet the entire system was built on borrowed sand. Demand for stocks wasn't rising because companies were earning more. It was rising because people were borrowing more. And that demand, artificially fueled by debt, inflated prices far beyond reason. As brokerages lent aggressively, banks were forced to supply the brokers, and the whole system grew, vertically stacked on thin pillars of credit that could snap under the slightest pressure. But to the public, the illusion appeared flawless. Newspapers celebrated the boom. Politicians praised American prosperity. Economists insisted the market had reached a permanently high plateau. Behind this curtain of optimism stood the financial titans of the era. J.P. Morgan Jr., heir to the most influential banking dynasty in the country. Charles Mitchell of National City Bank, a man whose ambitions were as grand as the skyscrapers rising across Manhattan. And Albert Wiggin, a shrewd strategist whose knowledge of market mechanics bordered on prophetic. These men played a decisive role in shaping the nation's financial conditions, and they understood what others did not. The prosperity of the 1920s was built not on the strength of the real economy, but on the swelling tide of speculative credit. Signs of weakness began appearing long before the public noticed. Rural banks failed quietly, one by one. Agricultural incomes fell. Car sales plateaued. Construction slowed. Steel output weakened. But none of this mattered to Wall Street. As long as cheap credit flowed, the stock market soared. Even when the Federal Reserve issued repeated warnings about dangerous speculation, the public shrugged them off. The dream was too intoxicating. By 1928, the bubble was expanding at a pace that made seasoned financiers uneasy. Margin requirements were dangerously low. Investors could borrow up to 90% of the cost of a stock. Some brokers extended even more. And while the public borrowed heavily, insiders did the opposite. Corporate executives reduced their personal holdings. Banks quietly limited their exposure. Wealthy families diversified into bonds and hard assets. The public didn't notice the shift. All they saw was the Dow climbing. All they heard were predictions of endless growth. Every dip was framed as a buying opportunity. every warning dismissed as gloom. The belief that the market would always recover became an unspoken national creed. In the summer of 1929, the illusion began to flicker. June brought unusual volatility. July saw a surge in trading volume. August delivered a sharp dip followed by a suspiciously quick recovery. Beneath the surface, the foundations were cracking. Interest rates rose as the Federal Reserve tried to slow the speculative fever. Banks restricted call loans. The cost of borrowing increased. Yet the market drifted sideways, supported by nothing but faith. In early September, the Dow reached its all-time peak, 381. For many, this number symbolized destiny. To others, it signaled a countdown. Within weeks, large-scale selling began. But each decline was followed by a comforting rebound, just enough to convince the public that everything was fine. It wasn't. By October, anxiety spread among brokers. Whispered warnings passed between telephone operators and bank clerks. Some investors tried to exit quietly, selling significant blocks of stock without attracting attention. But the machine of speculation was already winding too tightly. A minor spark could ignite catastrophe. That spark arrived on the morning of Thursday, October 24th, 1929. Just before the opening bell, tension clung to the air like static. Stories circulated about foreign markets selling off sharply. Brokers on the floor sensed trouble. When the bell rang, sell orders flooded the exchange. Prices dropped instantly. Within minutes, a wave of panic selling washed over Wall Street. The pace of decline was unlike anything the market had ever seen. Stocks opened far below their expected prices. Orders backed up. Brokers screamed into telephones trying to execute trades that could no longer be processed. And then the most frightening event of all occurred. The ticker tape fell dangerously behind. First by minutes, then by an hour, then more. Investors outside the exchange had no idea what their stocks were worth. They believed they were watching real-time data, but they were reading history. Amid the chaos, a small group of the nation's most powerful bankers convened inside a solemn building at the corner of Wall and Broad 23. Wall Street, the headquarters of J.P. Morgan & Co. The men in that room understood that if the market collapsed fully that day, the financial system might not survive the weekend. Banks would fall. Factories would close. The country would face turmoil unlike anything in modern memory. They chose to intervene decisively. They deployed a theatrical gesture designed not to solve the crisis, but to restore confidence temporarily. Richard Whitney, the bold and respected vice president of the New York Stock Exchange, walked onto the trading floor with an order to buy 20,000 shares of U.S. Steel. At a price significantly above market levels, he placed similar large orders in other blue-chip stocks. It worked. The panic slowed. Prices stabilized. Newspapers praised the bankers as saviors. Many believed the worst had passed. But the gesture was nothing more than a pause button pressed on an unstoppable mechanism. Over the weekend, the general public relaxed, reassured by headlines announcing a dramatic rescue. Yet inside the nation's financial institutions, fear deepened. Banks faced severe liquidity shortages. Brokerages struggled with margin calls they could no longer fulfill. Foreign markets continued to tumble. Credit tightened further. When the markets reopened on Monday, the temporary calm shattered instantly. Sell orders overwhelmed the system from the opening bell. Prices plunged relentlessly. The Dow fell 13% in a single day in unprecedented collapse. The next day, it dropped another 12%. Billions of dollars evaporated. The trading floor became a portrait of exhaustion, fear, and disbelief. Men who had grown wealthy over the past decade watched their fortunes dissolve in hours. Brokers shouted until they lost their voices. Some fainted, others froze, unable to act. The ticker lagged by nearly 3 hours, leaving the public in the dark. The collapse triggered a chain reaction across the country. Factories laid off workers, farms failed, banks closed without warning. Businesses crumbled under the weight of unpaid loans. Families lost their savings overnight. Unemployment surged. Breadlines grew. The American dream evaporated into dust. The catastrophe did not merely erase money. It destroyed trust in the market, in institutions, in the belief that prosperity was permanent. And as the crash gave way to the Great Depression, Every policy decision intended to help seemed only to make matters worse. Taxes were raised when they should have been lowered. The money supply tightened when it should have been expanded. Global trade collapsed under heavy tariffs. Banks refused to lend, worsening deflation. The system spiraled downward. It would take a world war, not financial policy, to finally pull the United States out of the depression that followed the crash. The story of 1929 is not just a historical event. It is a pattern, a repeating cycle of leverage, optimism, denial, and collapse. And the uncomfortable truth is that the global financial system today mirrors many of the same vulnerabilities. Debt levels are higher than ever. Speculation thrives. Margin trading has returned in modern forms. Household debt, corporate leverage, and government liabilities have reached unprecedented levels. Asset prices soar beyond fundamentals. The belief in endless growth remains strong. The idea that crashes are impossible persists. The signals are familiar. Mechanics remain unchanged. As history has repeatedly demonstrated, systems built on excessive leverage fail not gradually, but suddenly. Not gently, but violently. The final hours before the 1929 crash were not pure madness. They were the predictable unwinding of a system designed to break the moment. Confidence vanished. The lessons remain urgent. Crises begin long before they become visible. Insiders often act ahead of the public, and no market, no matter how confident, how celebrated, or how beloved, is immune to the unforgiving arithmetic of leverage. Those who study history do so not to admire the past, but to recognize the future hiding inside it. If you want more documentaries that expose hidden financial history, reveal the mechanics behind debt-driven economies, and break down the repeating cycles shaping our world, make sure to subscribe, like, and share this video, because understanding the past isn't just about history. It's the only way to avoid becoming a casualty of the next collapse. This is the story of 1929. Its lessons are more urgent than ever.